In this example, we're going to do PF4-35B. Basically, we are going to prepare the financial statements for this business and then do the closing entries and the post-closing trial balance and end with that. So let's start with this first part, prepare the company's income statement for the end of the year. So to do that, we're going to need the adjusted trial balance. So let's start with the revenues at the top. So we have revenues, and it looks like if we look on the adjusted trial balance here, that they have service revenue of 48,100. So now let's drop down to the expenses, and we see all the expenses listed here. So let's just roll through them. Remember to be careful about interest expense versus interest payable. Interest expense is an expense account, interest payable is a liability, and so on the income statement we're just concerned with the expense accounts. And so we just get the numbers for all these from the adjusted trial balance. And I forgot one, depreciation. So we then get our total. This doesn't go there. And so when we add this up, we get 4,700. So we notice something here, that our revenues are less than our expenses. So in that case, we're going to have a net loss. So how do we do that? We have in parentheses, we take the difference. And let's see. Okay, so the income statement is done. So now let's look at the statement of retained earnings. Again, we're going to have to continue using this adjusted trial balance. So we have our beginning retained earnings balance that we get from here. We're going to then add in, rather subtract the net loss, and we're also going to subtract the dividends, and that will give us our final balance. So we get our net loss again from the income statement here, and our dividends are also taken from the unadjusted trial balance. And so when we do the math, we see that our ending retained earnings balance is just $600. Okay, so now we have our ending retained earnings balance, so we can move on to the balance sheet. So we start with our assets. So at the top, this is a classified balance sheet, so we're going to start with the current assets at the top. So we always start with cash. We have accounts receivable. Well, let's actually see. So we have cash, accounts receivable, office supplies, prepaid insurance, land, building. So these are our assets. So the current ones are going to be these first 4 assets here. Land and building are not current, so let's add these. We're making an assumption prepaid insurance could be for multiple years, but typically it's a year or less. So I think that's a pretty safe assumption, and so that's why it's included in the current assets section. And so we then have our total and make sure you're choosing total current assets and not total assets. So we add these up. Okay, so the next section is going to be property, plant, and equipment, and that's going to include our land and building. And so we know that this section down here is going to be building because we have space for our depreciation, and we know that land is not depreciated. So you kind of have to use your judgment and common sense to know how they're trying to set up this balance sheet to make sure you're putting stuff in the right place. So land. And so now we move on to this section where we're going to have our depreciation. So we have our building, and it's going to be less accumulated depreciation. And remember, this is different than depreciation expense. Depreciation expense we already included in our income statement. The accumulated depreciation is a running total of all the depreciation expenses that we've taken over all periods. So we have building, and again, this building 71,000 is the cost basis. It's the historical basis, and we then show the accumulated depreciation off of this cost basis. So then when we subtract these two, 35,800, and this is almost correct, but we may have to make sure that we have to put these parentheses to indicate that this is a subtraction. So then we have total property, plant, and equipment. And then finally we have total assets. We add up these two numbers. Okay. Oh, something went wrong. Okay, I think I see the problem here. I just forgot. Put this. Let's see if this works. Okay. So now we're going to do the other side of the balance sheet, the liabilities and equity. So again, classified balance sheet, we're going to start with the current liabilities. And if you look here, we have these 4 accounts payable, interest payable, salaries payable, unearned revenue. Here we have our total current liabilities. We add all these up. Okay. Now we have our long-term liabilities. And we have a note payable here. So our total liabilities now, we add up these two, and get. So now let's do stockholder equity. So there's common stock and retained earnings. So the common stock we get from our adjusted trial balance, it's $5,000. And then the ending retained earnings balance we get from our statement of retained earnings, $600. And so we get a total stockholders' equity of $5,600. And then finally, we have total liabilities and equity, where we add up this and this. And it should be equal to this total assets based on our accounting equation. Okay. Okay, so now we have our closing entries. And so again, I'm going to reference this diagram here that shows all the steps for closing. So we're going to first close revenues to income summary. So we have to take our credit balance for revenues and zero it out by debiting it and moving that revenue to this income summary. So we debit service revenue, credit income summary by our revenue which we got from this adjusted trial balance. Don't forget the memo. Next, we're going to close out all of our expenses. So if we look at our diagram, it's going to involve crediting our expense accounts and debiting income summary. So we're going to be debiting income summary, and we have all of our expense accounts listed here. And so let's put in these individual amounts. And again, we're getting them from our unadjusted trial balance here. And so when you add up all these credits, you basically get a debit of $54,700. And if you look back up, that's essentially our total expenses here. It's the same number. Memo. Okay. And so now, if you look at our diagram, we've moved all of our income, rather our revenues and expenses to income summary. And again, income summary is now essentially like our income statement. It's matching our revenues against our expenses to get either a net income or a net loss. In this example, we had a net loss. So it's actually going to be a little different than this diagram because this diagram assumes a net income. So in order to close income summary, we actually have to, instead of debiting it like we see in this diagram, since it's a debit balance, we'll actually have to credit it. So we'll have to credit income summary. And where does it move to? We're moving income summary to retained earnings. So we have to debit retained earnings. And basically it's going to be the same amount as our net income. And in this case a net loss, 6,600. And remember, the debit and credit system, there's no positives and negatives. What this is essentially doing though is subtracting, because retained earnings is a credit normal account, and so when we debit it, we are reducing that credit normal account by this debit. So the debits and credits again is a way of adding and subtracting accounts. So it's essentially achieving the same thing as taking our beginning retained earnings balance and subtracting the net loss for the period. So that's what this entry here is doing. And then finally we have dividends that we need to close out. So if we look at our diagram, dividends is a debit normal. So in order to close it, we have to credit it and then debit retained earnings. So we will debit retained earnings, credit dividends by 25,800. Okay, so now we have to have our T accounts basically reflect all these closing entries. So many of these will be unaffected. So for example, cash, it's not affected by the closing process. It's a permanent account. Accounts payable, unaffected, permanent account. Revenue, however, is going to be affected because we look back up here, we have this debit here. So we need to have a debit and so when we debit it, we see here that our balance is going to be 0, which is what we want to achieve. So just a high level note here, the order of all this matters. We had our adjusted trial balance here. We then used these numbers to create our financial statements. After the financial statements are created, we then want to zero out all the temporary accounts to get ready basically for the next period. So after the financial statements are prepared, we're now going to close out the books for the period by doing these closing entries. So that order is important, because if we did the closing entries and then did the financial statements, all of our expenses and revenues would show 0 balances. So you need to make sure you do the financial statements first while these balances are still open for the period. And then once you're done, you then close them out to 0 them out for the next period. So that's just a high level note. And so this service revenue being 0 for the next period is what we want to achieve post closing. Account receivable is unaffected. Again, these balances that are unaffected are permanent accounts that carry forward to the next period without being closed. The expense account was closed in this closing entry here. You see that there's a credit of this 4,100. The balance is 0. So I'm just going to go through here and basically continue this pattern. Another expense account was closed out just like the one above. It was in the same closing entry because we closed all the expenses out in this one entry here. This is a little tedious, I realize, but it should emphasize the fact that there are certain accounts that are temporary and some accounts that are permanent, like buildings, common stock. So hopefully going through this is clarifying that point. Dividends was closed out also, and I believe it was the fourth. Yes, it was this closing entry 4. Okay, so retained earnings, it was involved with a couple of these. So in the closing entry 3 and 4, we debited retained earnings. So in this, this was number 3. And then we had number 4, which was basically the debit to this dividend closure here. And so when we add all this up, our retained earnings balance, we know, is $600 credit balance. And then we had our income summary, which were basically closing entry 1, closing entry 2. So let's pay attention here with these different lines. So there was going to also be another, right? Yeah, so there's another credit here for number 3. So we put it kind of in a different line because we first have these two. So closing entry 1 was our revenue, and the amount was $48,100. And then closing entry 2, if we look back up here, income summary, debit $54,700. So that gave us, let's leave that blank for a second. That gave us a balance of $6,600. But then we had our closing entry, close it out, and that gave us finally a 0 balance. Okay, that was a lot of work. Let's see if we got it right. Okay. And then finally we have our post-closing trial balance. So we're basically taking all the balances from these T accounts and putting them here and not including the zero balances. So let's start from the top. So we have all the assets. Now we're doing the liabilities. And finally, the equity. And so if we go back up here, we can find all the balances. Like we see cash has a debit balance of 5,000. So I'm just going to fill them in. And remember, accumulated depreciation, though an asset does have a credit balance. And then all these liabilities have credit balances. Let's just prove it. At least this first one, accounts payable, I'm saying is a credit balance of 18,700. So if we go up here, we do see indeed that we have accounts payable, credit balance 18,700. Okay, so now when we add up our debits and credits, they should be equal to each other. Okay, that's it.